you can lose everything if you don't have, protection or the right pockets or the ability to, double down or to invest, when it's down. It was a scary 2 months. We did not want a really long, widespread, talk to the whole world process, irrespective of price, just that you're not doing that with the person that you're going to potentially work with.
This is Built to Sell Radio with your host, John Warrillow.
So you're looking to sell your business? My guess is you're actually not. My guess is that you'd like to know that you could sell your business down the road, but right now you're busy building it. And if that's the case, standard operating procedures can be your secret sauce. These are the documents that you need to show your employees how to do their work. And we've just developed a new ebook. You can get it at builttosell.com/SOP. Welcome to another edition of Built to Sell Radio, the podcast that helps you punch above your weight when it comes to negotiating the sale of your company. I'm your host, John Warrillow, and I'm thrilled to be back in your earbuds again this week with a very special episode. This is actually the first in a two-part episode. Robert Glazer built and sold a company, and now he's on the other side of the negotiating table acquiring companies. And so we've structured this two-part interview. The first part describes the sale of his company, Acceleration Partners, and the second part talks about what he looks for in an acquisition, wearing his acquirer's hat. I think that together they make a great combination. So this week we'll talk to Robert about his sale. Next week about what he looks for in an acquisition. Before we go any further, this is a bit of a departure for us. And I'm kind of curious about whether you like the discussion with acquirers and whether that brings a new dynamic you'd like to hear more of. So tell me what you think. You can reach me at John Warrillow on Twitter. That's too hard to spell. So go to builttosell.com. You can figure out how to spell it, but it's at John Warrillow. And I would love to hear your thoughts on hearing from acquirers and whether that's interesting to you on this show. But before we get further into the intro, let me set up Robert Glazer. So Robert built a company, Acceleration Partners, in the affiliate marketing / partner marketing space. Started from scratch, didn't raise any outside capital, built it to $28 million in revenue before selling it to Mountain Gate Capital last year. Big exit and a really exciting entrepreneur who's got a lot of experience to share. I took a lot of lessons away from this episode. I really liked the discussion we had around the difference between owner incentives and manager incentives. So the beginning of the growth of a company, oftentimes owner and manager incentives are completely aligned, but then as the business grows, they start to pull apart, whereas the managers may want to grow the business in perpetuity, and the owner starts to realize they've got a lot of money on the line and start to think about selling. And that's really a divergence that I think Robert did a great job describing for the first time on the show, I think, and I really enjoyed it. He talks a lot about his phantom equity structure and how he thought about that, which I found really fantastic and interesting. He also talks about the typical structure of a private equity deal. I know a lot of the deals that you're probably looking at right now are private equity backed, so I think Robert has some really interesting insights to share on private equity deals, in particular in a roll-up situation. So here to tell you his entire story, part one of a two-part episode, is Robert Glazer. Robert Glazer, welcome to Built to Sell Radio.
Thanks, John. Good to be here. And as I said, I feel, I was sitting in a classroom that you were teaching 5 years ago, and I took your notes were very helpful. So,
dude, teaching in air quotes. Let's be clear. Teaching in air quotes.
I took a lot of notes. They were all very relevant.
Oh man, we met for our listeners. We met at something called the Entrepreneur's Masters Program, which is an EO program done out of the MIT campus at Endicott House. It's a beautiful, building, an amazing program. I went through it as a student, and when it was called Birthing a Giant, which has got to be the most pretentious name on on the planet. But that's where we met, where I had the opportunity to kind of come back as alumni, which was really special.
Yeah, and if anyone ever did, and I think some people like a longitudinal 5 or 10 year study of the people in that program, I'd say there's about a 80% exit rate at 5 to 10 years.
Yeah, I think that's probably true. Yeah, I got a ton out of it, and it was great to meet you. So let's talk about Acceleration Partners. So for those listeners who don't know the company, what did you guys do? What industry are you in?
Yeah, so I joke with people, I think we're kind of a big fish in a small pond, although the pond's been getting bigger. We have been an agency focused on affiliate and partner marketing, which has always been a niche part of e-commerce, has existed for almost 20 years, but has gone through a whole bunch of different ups and downs and some scandals. And back in the early 2000s, which I wrote about in a book called Performance Partnerships. But basically, because I always explain what we do and then they ask me for an example. So now I just go right to it. But we as opposed to buying clicks or impressions, we help brands, let's say 𝙁𝙊𝙐𝙇𝙊𝙀.com, connect with hundreds of bloggers or product comparison sites or deal sites or people that control content that write about things related to what Acme sells. Instead of paying for a click or a link that a click or impression, they would write about it, list to a product, talk about it. It's all tracked through software, and then they're paid on a performance basis, whether that's as a percentage of revenue or for lead or otherwise. So it actually looks similar. For years, a lot of people got their service and their technology in one place. And then the industry just started to look more like other industries where like you have Facebook, the product, but you have a Facebook agency, right? You have Google, the product, but you have a Google, search agency. We are the agency to people looking to launch mostly enterprise clients doing partner and affiliate marketing programs.
Got it. So if I'm, Nike and I want Mark Cuban to endorse my shoes, they might hire you and your firm to build out a partnership program for them.
Yeah, it would be less about one person than like we want to get thousands of partners and use software to kind of scale up and build a program with thousands of partners rather than, if it's a one-off thing, it might be a PR or business development type relationship.
Got it. That's a good distinction. Did you own the underlying software that you used, or did you third party? Buy so
we're like the key integration partner to a bunch of big platforms in our industry. Like we're kind of like a gold or platinum partner. So again, similar if you were to buy a hub, Salesforce or Infusionsoft or Google, there's an agency that is a certified partner in that. There's not like a single dominant one in our industry. So we tend to partner with like all of them and try to be one of their strongest agency partners.
Yeah, there's a handful of big players, and you were, if you will, agnostic of any one player. You could play the same box with all of them.
Yeah, we play because people come to us and they say we like the software, and we say great, we can work with that software.
Great. And so, talk about the staffing model. How did you staff this company? Like who are the kind of key functional roles in the company?
So we very intentionally and early on, maybe it's my background in consulting, we always. Two things that we did different than competitors in our industry. They tended to have more of this marketing model where you're sold by high level and then it's dropped to a junior and then the person's working on 20 accounts. Like often in our industry, it was an average of 20 accounts per person. Our model is more like consulting in that there's a senior or director or a strategist. There's kind of a manager, an associate. The associate would be more behind the scenes. You'd kind of talk to the manager week to week. You talk to the director kind of biweekly or monthly. And we have almost a 1-to-1 ratio of programs to people on the delivery team, still to this day. We just believe that building these programs requires and recruiting partners requires a higher resource level. I was explaining to someone yesterday, like you're saying, look, you can build a sales team with one person or 10 people. It's very likely to have different, volume and ROI based on how big of a team you want to put against it. So we tend to manage some of the largest global programs in the world. We have programs that have 10 or 15 people on one account across multiple countries.
What was your revenue per employee?
That's a good question. Matt's our numbers guy. I think it's in the 200,000 ish
200 grand
range.
yeah
Yeah.
I was gonna say, because
It
sounds like a relatively expensive model to staff if you've got sort of engagement manager level people on the client side, and then you've got manager.
Yeah, we are not the cheapest. Like we are in the upper right corner of like high quality, high price. And again, I mean, I've done the math for people when they're like, oh, and so-and-so's $3,000 a month. I was like, but here's the math of an account manager working on 20 accounts. You're paying $500 an hour. So I understand it sounds cheaper, but
trust me,
it's not necessarily cheaper.
Yeah. And did you start this business from scratch, or what was?
I did. Sort of accidentally got into running a program for a company called Tiny Prints. That was very early in the first kind of high-end photo birthday card, holiday card announcements. And the affiliate program there just actually connected with tons of mom bloggers. It was one of the first programs that connected with all these content partners, when at the time everything was very discount and deal oriented in the affiliate world. That company sold to Shutterfly for like $300 million. The affiliate program was a huge part of the company by the end of it. And, you know, long story how I got there, but classic. I still haven't met anyone who meant to start an agency. I was saying this to someone the other day.
So true.
Because they were talking about non-compete and around a deal we were looking at. They're like, trust me, I'm not starting another agency. It's like, so, you know, we were solving this problem, and then I couldn't do it anymore. And then I hired some more people. And then what happened was all the people left and went around Silicon Valley from Shutterfly to other companies. They're like, look, we want to build this sort of program. And they would call, and it just sort of happened from there.
Yeah. How did you grow the business? Was it out of cash flow? Did you bring in investors? What was the?
No, it was totally out of cash flow. For better or for worse, I always believed in making money. I never was comfortable with the concept of losing money, or I would have figured out a SaaS business and done a lot better. Yeah, we just, you know, we grew organically off cash flow, and you know, we had an almost 10-year, you know, combined growth rate of 25%. I mean, it was just pretty consistent year after year after year.
Good for you, and all out of cash flow, which is amazing. One of the questions
although profit and cash flow are not always the same, and in fact, in the years we grew the fastest, cash was strained the most. So you know, I think that's the classic trap that people fall into.
Yeah. So on paper profitable, but your clients are paying 60, 90 days later.
Yeah. You start moving up the client stream, and you get to enterprise clients, and they pay high amounts of money very reliably 90 days later, you know, and you need to staff those programs. So the gap grows.
Yeah, for sure. The faster you grow, the more cash you suck up. So as you grow, did you reach a point where you're like, man, like, I'd like to take a little bit of cash out of this business. Like, I'd like to upgrade my car. I'd like to pay off my house. Was there a point where you're like, this business is thirsty for cash, and I'd like to be the customer for a moment? Yeah.
But look, I'm a make it better growth person. And I think, you know, this is one of my learnings around, I think a lot of people get in the growth for growth's sake. You know, it just feels good to keep growing. So it always felt like the right thing to do. It felt like I'd be starving, you know, so I mean, I was fine. I didn't have a lot of needs. But yeah, I mean, the perception in some of these cases that the owner is making more and more money is very different than the reality. Again, even if you saw the P&L, it doesn't tell you the story on the cash flow. In fact, you know, years where sales slowed, you know, it would improve, you know, it would improve dramatically. It just always seemed like when we got to a point, there was a whole nother bunch of investments that everyone wanted to make. And actually that can really become a trap, particularly when you get stuck in just a revenue growth mindset and not a earnings growth mindset.
Interesting. How did you retain these very highly sought after people? I'm just going back to your model of employees, where you've got these very senior people that are interfacing with these very slick enterprise customers who are, let's face it, in really high demand right now. What was the retention model? I mean, were they getting options? Were they getting deferred comp in some level?
Yeah. So we had a great culture. We've won over 25 different best places to work awards. Actually, the talent was super fractured in our industry and we needed senior people. So we were a company that went fully remote 10 years ago. Like we were literally hiding it from clients because we didn't want them to not take us seriously. We had these Fortune 500 clients and, global. And honestly, it was something we used the word distributed, and then I wrote a book on it years later. But we had this, our culture was it's funny, everyone's focused on remote, but I always say it was a very high performance. It was accountability and flexibility. If you were accountable and high performer, because everything we did was measured and we did well when our clients did well, you could have that flexibility. And so that was really attractive to people, who wanted that in their life cycle. We had a lot of young parents as employees who had kids and wanted flexibility. And that was, we focused on really being a good place to work. We did a bunch of things that were just a little different in our industry. We just promote people when ready. Like we never, we would promote them when ready. We tried to eliminate sort of 2 weeks notice, this concept of open transitions. Like, hey, when you want to leave, just let us know and we'll let you work here and help you find a new job. So, some of the stuff worked, some of the stuff didn't, but, we tried to be a good place to work. I mean, typically agencies are kind of churn and burn, but, 90% of the leaders of our company have sort of grown up in the organization. So we focused a lot on training and leadership training and just, moving people up. And, that's where growth is helpful because it just creates new roles and new growth paths every year if you have employees that want to move up.
Back to the question. Did they get any sort of incentive-based comp?
Oh, sorry on that. So we have bonuses and we did roll out a phantom equity plan for, I would say, sort of the top third of the company at the time.
How did you structure your phantom equity program? I think a lot of people have heard the term phantom equity, but I think it means a lot of different things to different people. What was the structure of yours?
We changed it a few times, and you got to be careful based on tax stuff. Everyone hires the cheap lawyer early on, and then they wish they hired the more expensive one. But basically, it meant to mimic the value creation of the company. And so, at the point that you came in, there would sort of be a mark to market, and then there was vesting, and then we would use, a metric to evaluate it. And then, if you left or if the company was sold, there could be a liquidation point. I actually wanted to have a way to make sure that, if people were there for a time, a lot of companies, it's like you lose everything if you leave. And I think that gets you into some dragged out problems or lawsuits of, someone's been there from 1 million to 10 million and they're just not the right person from 10 to 20. I think you'd rather pay them for what they've done than try to have them hang on, or you try to push them out and then they, are pissed because they have this equity. So I think that's the downside. So, I tried to do something a little bit different, which was to let people, hold on to the value that they had created and actually, if they left, get some of that even in lieu of a liquidity event. However, it wouldn't be it would probably be a lower value, but at least was something.
So if somebody left after, to use your example, from they start at 1 million, they go to 10, they leave, you were paying them a portion of what they would have earned on a liquidity event? Well,
there was just a basic valuation. And then you could say that you were here from 1 to 9 million and you had 1%. So that's, 1% of that 9 million or whatever it was. You can do a formula, and then it's just sort of, it's executed as a bonus, really, as a revenue bonus.
Okay. And they would earn that. They would basically get a check for that amount of money when they left.
Yes.
Got it. And so in a way, didn't that incentivize people to leave? Like if they needed to buy a house or a car or whatever, they're like, hey, I've got this kind of unrealized value.
It didn't, because the way you have to, not to get into the complication, do these things, but that value probably is not going to that has to be more of like a book value, right? It's probably not going to represent market value. So if you were to do that, you'd probably be leaving some money on the table, because you can't, those sort of valuations have to be pretty basic. They don't tend to be mark to market type events.
Got it. Yeah. Book value obviously being different.
Yeah.
Than the
so we had a formula, right? But again, yes, I don't know that it's an incentive to leave. Again, I think if you were there and you, like I said, I one of the things I think you see, and someone once told me this, most true thing I've ever seen growing a company, I think every time the company doubles, you break half your people and half your processes, right? And I think if someone got you, was the right person from stage A to B, then they should be valued for that. And then you move on and you reallocate that for someone from B to C, right? You sort of you're resetting the index for the next person, basically.
Yeah. What was the formula you guys used to value the company for the purposes of the Phantom Equity program?
It changed a few times, and we had to make changes, obviously, as it got more complicated. I think it was just a very simple revenue multiple at the time.
Do you recall what multiple of revenue it was?
It might have been 1x or something like that.
1x revenue.
Yeah.
That'd be pretty common for a services business.
Yeah,
I would have thought. Yeah. Got it. That's super helpful. So, how big did you get this company before you decided to sell?
Let's see, I think in 2020 we ended up finishing the year high 28 million, something in that range in revenue. 28
million.
Yeah.
In revenue. And how many employees?
It's changed so much. I think it was probably about a little under 200.
Got it. Wow. This is a huge run. And how long did you own the business for? When did you start it?
It had been 14 years. So 2007. Wow.
Congratulations. That's incredible growth. And you were able to hang on to all the equity along the way. It's amazing.
Yeah. Well, again, we give a good amount to team, and I think that's important. But yeah, services businesses, when someone does a service business, I hear they're raising money. Like, it's not, you see all the debates with Goldman Sachs and all that stuff. It's very tricky raising money in a service business because it's the people. And then you get into this debate with the profits of, is it the people that are selling and generating it? How much do they want? Like, when you think about Goldman and the shareholders, they can argue, is 10 million enough per partner? Or like, what should go to the shareholders and what should go to the partner? So I've not seen a lot of success with companies, service businesses that have raised money. I just think it becomes problematic.
Yeah, but in your case, it didn't matter because you didn't have
matter.
to. And
nope.
Yeah, you were able to grow profits in lockstep. I'm John Warlow. You're listening to Built to Sell Radio, and my guest is Robert Glazer, founder and CEO of Acceleration Partners. What changed? Like, what triggered you to want to sell?
As a business starts to get that big, I almost felt like I had this house that I couldn't afford, a little bit from, you own the house, but like the maintenance is a lot. And so, we were doing fine and COVID hit, and, it was really scary, for 4 to 8 weeks. And we had actually gotten to a point, we had chased revenue growth for a lot because we knew that if we got over 10 million, that was a certain threshold in terms of value creation. And, businesses under 10 million, and certain EBITDA level, they tend to be too founder centric. So I knew I wanted to create something that was valuable beyond myself. And so, we got big enough and got to that point. But in doing that, we were constantly reinvesting. And, it reached a point where we're about to sort of harvest those rewards. And, the management team understandably wants to keep growing and bringing people in. And I'm looking like, look, these numbers are getting, pretty big. And, one of the things I would say is I had this $500,000 home equity line. Well, for a while, our 𝙎𝙬𝙊𝙀𝙇𝙊𝙀, our credit line was personally guaranteed by, me, until we got big enough. And I had this $500,000 sort of emergency equity line on my house and use. And, for years that would have covered 9 months of payroll. And by that time, it would have covered like not even a month of payroll. And so, I had thought about it kind of like, hey, I'd love to do this, but I'm not sure I want to just reinvesting, or this is a big checkbook. Like, what it takes to backstop this business right now is more than I have. And I think COVID was sort of a wake up call on that too, in that, you can lose everything if you don't have, protection or the right pockets or the ability to, double down or to invest, when it's down. It was a scary 2 months until things sort of stabilized. Eventually our industry, did pretty well. But I think coming out of that saying like, wow, me being the sole backstop for this, having to maybe reach in and find, millions of dollars, in emergency money, like it just felt like too much concentration.
Gosh, I think you just articulated in a really eloquent way what so many people have felt, but maybe at least in my own experience have failed to articulate quite so well, that you were living in a house you can't afford. And it's such a good point, because
your rich uncle gave you the house, but the oil bills and the taxes, right, and all that stuff.
Yeah. I mean, we talk about your company becoming a huge part of your net worth and how that gets a bit scary at times. But it's more than it sounds like for you. It was more than just a concentration of equity in one asset. It was okay, if we have a month where things go really sideways, your payroll at 28.
Right. I mean, this is a service business, so assume your payroll is 90% of those costs, and that's all people. And I'm like, wow, you're at this gets personal, but you're at a decision between you have to put you're putting your family's welfare against the welfare of other, like and I just increasingly was like, I don't ever want to be in that position to be like, well, do I have to choose between my family's well-being and the well-being of my employees? Like I've seen people get into trouble, or you can, just, they're good opportunities and you're growing. But yeah, if you look at those numbers and you start to just say, yeah, a tough 2 months or a couple clients don't pay, or you're investing a bunch and, coming up with a couple $1 million when you have all that wealth tied up in the house, it's like you have the house without a home equity line. And by the way, the home equity line is backed by the house, so it's all circular. So yeah.
Yeah, it's really interesting. At what point were you able to remove the personal guarantee? At what revenue level?
I think that was the year, I think when we got above 10, I sort of went to the bank. Actually, that came out of a forum or our board of advisors. We had actually built a board of advisors that was non-fiduciary, but we had presented them like a board meeting. It was great practice. And one of the board members who really didn't even understand our business, that was one of the discussions. Like, you go tell them you're leaving if you don't do it. And you say, look, we're at this thing. So I think it was about 10 million. And yeah, that was a $2 million equity line backed by my house, basically, at the time.
Yeah. And I think for a lot of entrepreneurs, it's a real milestone to get that personal guarantee removed, right?
Yeah, that felt really good.
Yeah.
Again, the numbers had gotten really, they get big, right? And you look around, yeah, the numbers are big.
Yeah, no, for sure. So what happens next? So you're at this point, you stabilize after the worst of COVID, the first 4 or 6 weeks when everything looks like it's going upside down. You stabilize. What did you shop the company? Did you hire like a banker? What was the next step?
So we survived. We got through the summer. There had been some interest. We had been having some discussions before COVID. We had sort of started because I had discussed with the management team. I said, look, we're going to look into this route. I started to learn about there was some interest in our industry. There really hadn't been private equity and platform in our industry. Our industry was starting to consolidate. The tech players were consolidating, the service players. So a lot of discussions were going on. Then COVID hit. We stopped all the discussions with everyone and said, we got to just go man the ship, stop the bleeding by the summer. Then the industry actually did very well towards the end of COVID when people started to realize, hey, when our budgets are precarious and tight or whatever, we'd rather pay only on a performance basis than lay out money and not know what we're getting back. We helped companies liquidate stuff. So I think by the fall, when we felt like we could take a breath again and looked around, we restarted some of those discussions. There was a bunch of interest. We had 2 or 3 people pretty interested. And based on all of I'm a big believer in the experience share and EO and YPO. And I just call all my friends who had done transaction otherwise, and they're all like, hire a banker. Like, I mean, that is the advice I give everyone else. I mean, the people I see trying to do it themselves, these businesses don't sell usually. That again, just in my experience and what I've what I've seen, and or they focus on the cost of the banker and not, what the delta is in their cost versus what competitive does. I mean, I had multiple friends tell me that, because a lot of particularly what investors or private equity firms do is they get this shot at this business, they discover it. It's not, you think they'd make a really good offer before it went to market. What most people told me was, that last offer that they got before they took it to market was 30 or 40% below where they ended up, sort of on average. And so after I heard that story 5 times, I learned slowly.
Bit of a slow learner.
We went to a couple of the best banks in our industry, and picked a good one. And they understood we did not want a really long, widespread, talk to the whole world process. Like, we had some people already interested. We had some other people we thought we were interested, and we wanted a pretty, smaller, controlled process. I mean, we were very focused on the right type of partner, fit, who the people were. It wasn't necessarily going to be looking for the highest bid. But I think making a market is extremely important in terms of urgency and price, and
making a market, for folks listening that may not understand that term, meaning getting multiple potential acquirers to the table at a similar time, so that they're all kind of looking at the same information at a similar time.
And look, this was still September 2020, and so look, the banks and law firms, I mean, they were being very aggressive. I mean, I got a call from our law firm a year later that they were referenced, and they were great. I mean, the price that they quoted them for almost the same size deal was almost double. So this was, there were still, people were being aggressive with M&A business in the fall of 2020.
I want to make sure people understood also, you referenced hire a banker. You don't mean walking into Bank of America and hiring like a teller or whatever. No. You're talking about an investment banker. They're also referred to as a mergers and acquisitions professional or business broker, depending on the size of your company. The very low end business broker and mid-market sort of M&A professional. And then on the high end, when you're selling big companies, they often refer to as
And look, there's generalists and specialists. And we went and talked to 3 specialists in our industry with experience in our industry. That's another thing I think there's a huge difference when people have repetitive experience in your industry. Because what I've actually learned too with bankers is that a lot of the times the highest bidder is the one who lost out on the last deal with that banker who comes in, right? They know the person who wanted to buy X agency and lost out on the last one.
Yeah, although I think, and I wondered to what extent you felt this way, or you considered this, that if you go with an investment banker or an M&A professional with an industry specialization, the risk you run is that they make their living selling companies to 1 or 2 businesses, and they're not going to jeopardize that relationship with that acquirer to get an extra 3 or 4% for you. Were you aware of that potential criticism of going with an industry partner? And B, if so, how did you sort of get your head around going with one?
Yeah, no, that never came. It's interesting. I didn't see that. I had just talked to, again, personal references and experience of people who, just felt like they were very well served. Again, our banker had actually worked with one of the top people that was interested. I thought that was an asset in terms of some trust there. But they were good at, what they did. So I can see that. I think we just knew that there was interest in our industry. There was interest in building a platform in our industry. So I think we just had a strong feeling it was going to be someone, in our industry that was going to be the better fit for us.
Yeah, for sure. I want to explore something, and again, it's sensitive, and I acknowledge that. So if it's something you can't talk about, I totally get it. But you referenced earlier that you built a $28 million business. You've got a $500,000 HELOC guaranteed against your home.
Two things. Why I had the HELOC, and then I had the actual, equity line for the business.
Line of credit. You were there for a rainy day. I mean, you had risked personally, your family, you personally, Robert Glazer, had risked a lot to get the business to where it is. And in my shoes, I feel like you therefore deserve the lion's share of the reward. Like, you were all in personally. And while your managers may have come along for the ride and they were key people and they were, at the end of the day, it was not their home on the line. And so when it comes time to selling, I'm envisioning a conversation among some managers who may have only a small amount of phantom equity or only a little bit of upside in terms of selling, saying, hey, like, Robert, what's the big rush here? Like, we stabilized from COVID. Things are okay. We've got it to 28 million. Why don't we go to 50? Was there that sort of tension among the management team that there were some people that they were like, Robert, I don't want to work for some private equity company. Like, why do we have to sell?
Well, no, there weren't. I actually don't think there were, because I think we had the right people who had actually invested a lot of blood, sweat, and tears, if maybe not money, and had taken different risks to come to the business, when we were smaller and maybe not at the same level, but I think they took risks. But I mean, this can more get into it, but this was really more of a beginning than an end. Like, this was how are we going to become a first $100 million revenue company in our industry, huge upside. Like, I think that we could do this ourselves, and continue to, use the match and the lighter, or we could like get some gas on this. And when we look at what that really means for everyone, and particularly the type of partner that we worked with that really believed in heavily incentivizing, management and tying that together, I think that's what really excited everyone. They wanted to grow and do that, and they could see that like I was not probably willing to fund the growth at the same rate that the business could have supported. And actually, when I look back a year later now on what we have done in a year and what we could have done on our own and where the business is now, I mean, that's a no-brainer.
Hey, this is Built to Sell Radio. My guest today is Robert Glazer, the founder and CEO of Acceleration Partners. My name is 𝙬𝙊𝙐𝙇𝙊𝙁. But you'll acknowledge that there is a difference of incentives and a difference of personal situations, right? Like, if you're a manager, you want to work on like bigger companies, more exciting deals, bigger budgets, more, the LinkedIn resume needs to get primed up. I want to go from VP to senior VP to executive. Like, that's what I want as a manager, right? But you're an owner. Like, let's be honest, you could walk away and never work again. It doesn't really make a difference to you personally whether your title goes from VP to senior VP to. So the incentives, I'm acknowledging. I think it's important to acknowledge that for an owner, the incentives and the risk, it's at this point in the company evolution where it becomes very clear that although we all row in the same rowboat and we're all happy together and we all make this, like, we all make nice that we're a big family, the owner and his or her managers are in different boats. It's at this point in the juncture, you are not equal. And I
agree with you.
That.
And I actually think that's why. So we were not equal in the sense that I think we actually got to the steady point where finally profit was a level where I could start de-risking, right? But that actually meant not growing the business and limited upside for people. And that was sort of the divergence that I saw. So actually for me, the answer was, where can we bolt on and give you guys all the upside where you can really make life-changing money over the next, 3 to 5 years? Because again, I'll be okay. That's actually why we sought the type of deal that we did. It definitely wasn't an ending. If it was an ending, people might have had a different thing than it was a beginning to hopefully what's a 5x build of a platform.
Yeah. It's a really good point. And I think it does, like, it sets up who you sold to. So let's go through that. So you make a market, you've got this M&A professional who is very steeped in the kind of partner marketing field, knows all the players. Strong, and there was no one in partner marketing, so that was the thing. But so we looked at what are the closest things, like agency, transactional experience, digital agency experience, and ad tech experience. So like those were the two sort of, that's where they had a lot of experience. Got it. Okay, thanks for the clarification. So they're steeped in that space. Yeah. They shop the deal. How many sort of folks did they shop it to? How many LOIs did you get?
Yeah. So interestingly, we had three people pretty interested, and this was what once we had three people interested, I had all the advice. I don't want to do this myself. One of the analogies too that someone said is like, look, this is like negotiating with someone who's buy the home where you're going to live with them, right? They're everyone I talk to, you want distance. If you like, you really want someone in the middle of this, irrespective of price, just that you're not doing that with the person that you're going to potentially work with.
Totally.
Which is different if you're maybe selling it and walking away on the first day, which is not at all what we were doing. So we actually started a process. We had three people already interested. Those people were kind of ahead in the work. We did sort of indications of intent. We started scheduling management meetings. We were able to do it with all three of those first. Before the LOI, we got one made a letter of intent before the deadline, and then we let the others know. And there was one we just felt was a really good fit, and they basically came back, preempted the process. There was some negotiation. We felt like it was a good structure for the type of deal we did. It had all the elements that we were looking for, and we ended up. I remember my last call was with a very well-known. We kind of canceled the management calls in the middle and decided to go with that deal.
Wow, I got so many questions there. So you got three LOIs. Were they all private equity, or were they some?
They were all
agencies?
Private equity. That the people there had really been. It's a super fractured space, which is interesting in the industry, and no one had really. One of our competitors had, and so people had been studying it and looking at it. Our investors had a thesis on it for a couple of years. They were just very ahead of it. They understood the market. They understood a lot about it. And they just had an incredible track record in marketing services businesses. And for us, that was the real differentiator. Also, well, a couple of things, but yeah.
But what about all the big agency holding companies? Like, I'm surprised they weren't at the table. Were you intentionally looking for private equity because you wanted your management team to participate in the second kind of tranche?
Yeah, we wanted to build something. So John said this in your interview with him. He and I talked about it. When an industry is and this goes into the pros and cons of a platform. When an industry is rolling up, we had a very strong culture. We believed in our business. We loved our team. And when industry is rolling up, you can either kind of be the roller, roll in, or I think you get rolled, potentially depending on how fast it rolls. And so what I understood about, hey, look, if we are the platform in this, like it's our team, it's our culture, we get to go find the pieces. Like this sounds fun. And so that the private equity firms in this space have they have a model of either minority or majority interest. You roll in a ton of equity or partners in building it over the next couple of years, but you own your equity, in it. Like you could get in details, but a lot of these, depending on, you can walk, but you still own your equity, right? No one can take that from you. The big agency holding companies for years were doing these 5-year earnout deals and stuff. And frankly, they just hadn't won any deals in the last couple of years in our industry because private equity had become so interested in marketing and services and offering this sort of model. And the other option was 5-year earnout. And it was just, I don't know anyone that went that route. When I talked to all my peers and other folks that were in EMP, like it just was. I mean, the holding companies are going to have to change their strategy because I think the earnout is just earnout with not having the control is just so much less attractive than putting your risk in the deal, but separating your role from your equity and your sort of championship of that platform or partnership.
Yeah, let's make this clear what you were looking at. So you had 3 offers,
yeah,
and one of them was ultimately the successful acquirer was Mountain Gate. Is that right?
Yes, Mountain Gate Capital. Yeah,
got it. Yeah, and so you had 2 other acquirers, both of which were private equity groups. Were they proposing similar deal structures?
Very similar deal structures.
And what was this? What was this deal structure?
Similar. So majority recap, rollover. I guess we didn't get into the nuance of all of them. There's one thing that Mountain Gate does that subsequently I think is more different than I came to understand. So at a high level, they were all similar percentages. They were in the same ballpark. Similar to the banking decision, I knew someone who was in year 3 of a partnership with them, who since was Tenuity, Ben Kerzner, had a phenomenal outcome, and just raved about the team. And I had gotten to know them over a year or two. And similar to the banking thing, we had 2 firms who I also really loved, who were generalists, and Mountain Gate was a specialist, and they had just done this over and over again in marketing services. And we just had gotten to know the team, and just the fact that they had executed this playbook and understood the industry, and we just felt like they were going to be the right partner for us.
Okay, so they made an offer. What, if you don't mind me asking, what was the multiple of earnings that they offered?
Well, I'll tell you in the industry ones, because marketing services that I've seen, and again, this could go from 1 million to 10 million. At the time, the multiples were 5 to, I think the most anyone in the industry had paid was like 10 or 11, depending on size. With most of the things in the industry they were at like an 8 or 9 level.
Got it. And so I'm going to read into that you were kind of in that space somewhere.
Fair assumption. Yeah.
And got it. So we're in this sort of 8 or 9 space, but that's not all cash at closing, right? That's right. They're buying a majority, so more than half. Was it a 60% and then a 40% rule?
Yeah, it was a majority range. And look, and one of the things that we didn't have the data on that time, but the vast, because people tend to be focused on the upfront, the vast majority of actually in every single company in this Mountain Gate fund, the second return has been considerably higher than the first.
So-called second bite of the apple.
Yeah, and so one of the things too that was different, and I've seen this in a different transaction, is preferences are really important. Mountain Gate is very big on a partnership model. They're a small firm. They do not operate businesses. They want to be helpful, not hurtful. I know everyone says this, but also you got to look at the makeup of a firm. I had a coach of mine who was used to big buyout private equity, and he's very cynical, and he's been through it, and he's like, look, there are these operating teams there. They're just waiting. They're ex-CEOs waiting to take your job. Like, for Mountain Gate, it would be a worst case scenario to have to replace a leader that wasn't, going into it, or someone wanting to do succession. There aren't people to run the business. The folks who worked on our deal, from the sourcing standpoint, was our team that we've worked with since that day. But the rollover that, and not just me, but actually the phantom equity, all the management team was same percentages. Like, they wanted to see everyone roll that in.
So the phantom equity holders got this majority of their cash up front, and then a fairly significant.
Same thing. Yeah.
Yeah. Are you able to share? Was it 60-40? Are you able to share that level?
Yeah. It's in that range.
Yeah. And the other 2 deals, I'm reading in that they were similar multiples and similar equity rules.
Similar equity rules. And again, we didn't get into the details of this. And again, I probably would have learned this in the process. But one of the things that Mountain Gate does is that everyone has the same security. So their cash that they put in the deal and invest is the same security, same preferences as anyone who rolls in. There's no way for them to do well and not us to do well. And again, if you're going to talk about partnership, that is a partnership model. Like, I have seen other offers, and I was part of one where the rollover was subordinate to preferred equity, right? There's a way for, they're saying, look, your rolled over dollars are not the same as our hard dollars, and that creates two classes of shareholders. And this is a big part of their model.
And did you get a sense of what their thesis is for improving the valuation? Because marketing services, in your own description, like, they're not getting huge multiples. Even if you grew the business bigger and bigger, the multiple increase is not going to be, you're not going to double or triple the multiple. It's going to be a small increase.
Yeah.
Like, what's the thesis to,
well, they have averaged about 4x return the first 5 companies. So
how do they do that? What's the thesis?
So the thesis is customer centric, and is to figure out, they have a build and buy strategy. So, so tech enablement is what anyone needs to get a premium. If you're building a larger company these days, some sort of technology that helps you do what you do better. And then, they did this with Elite SEM and Tenuity, and, we hired a group to interview all of our customers, look at the market, figure out sort of what did our customers want to buy and what do they want to buy from us that we didn't have. And this is where they've had tremendous success. There are a lot of things focused on, look, private equity has a million different flavors, right? There's the cost cutting private equity. This is not, this is growth. There's the sort of scale private equity. This is true growth. So what they've been really successful is 1 + 1 = 3. What are the other things that we could add organically or buy that our existing customers would want to buy? Those new customers would want to buy our services, where it is not just buying for scale, but buying because that's the 1 + 1 = 3. And so that formula. So we sat down, they paid a substantial amount of money for this initial market research, which was both talking to our customers, and this is what they do at the beginning of everyone, and then also looking at the market. And we sort of built a map of, okay, by the end of our 4 or 5 year period, this is what our revenue should be. This is what the breakdown, we're planning on 25% of the revenue to be in services that we didn't even offer a year ago. And we had a real thesis for what people were going to want from a partner marketing services firm and where things were going to consolidate in the industry. And that really drives our M&A path and our map and everything we do. So I was super impressed with, this is not, again, the worst. They are not the type of person who would just tell us to buy something for scale, because that's just putting two things together. That's not getting the cross-sell, upsell, margin improvement from it.
Yeah, no, for sure. And I appreciate you sticking with me there through that explanation. And for folks who want to get your lens on how you think about it from a buyer's perspective, because I now know with Mountain Gates backing, you're now buying companies. We're going to do that in our next episode next week. So make sure you check that out. I want to finish today's episode with a quick lightning round we call due diligence.
It's time for Due Diligence, the point in the show where our guests answer a series of rapid-fire questions.
But I'm just looking for a quick, short answer to a series of questions. You into this?
I'm good.
Okay. Slimiest tactic an acquirer tried to use on you to pull the wool over your eyes?
Honestly, we didn't have any. We had great people we talked with, and it was so fast. So I can just tell you the one I've heard the most, and that is the quick LOI and then the 6-month drag out, right? I'm in a group with someone, one of these peer groups in which after his company was acquired, they were told by the department that they renegotiate at the last second because you get exhausted. You get just physically exhausted emotionally. But that was literally their tactic, was to come in at the 11th hour and lower the price. And that was just part of the business model. So, the way most entrepreneurs, you can really insulate yourself against that and they're necessary in this market, but short windows, like 45-day, 60-day windows, where by the end of 30 days, this thing is moving or it's not. It seems to me like the longer it goes, the more one side's going to end up overwhelmed or underwhelmed. So I felt super lucky that we had a very quick thing with highly ethical people. So I didn't see anything slimy directly.
Biggest mistake you made in the process?
I think, and this will go to our second episode, I wish I'd pay more attention to how our industry valued companies, right? Because I think, and really paid attention to that in our own metrics. I think we tried to keep growing for growth's sake. Ours is a EBITDA-oriented industry. And I think if we had oriented ourselves around that in our management philosophy and stuff earlier, it was hard to get people off the revenue growth mindset after being on it for so many years. The other thing I would just say is it is physically and mentally exhausting and debilitating, the due diligence process. It actually takes months to recover from. And I've talked to people at the beginning of it, and I'm just prepare yourself. This is going to be terrible. Even in a good deal, it is. And I remember actually one day we are international, and law firm sent us 22 questions about the one Italian employee we had, and whether we, whether we used like certain algorithmic hiring in Italy. And I just like lost it. I was like, I sent the investor a note. I was like, this is just ridiculous. He's like, you're hitting grade 4 deal fatigue. He's like, it happens to everyone. Like and you're at this point, you just want to like, go screw it. He's like, you need a good night's sleep. So it's a real, those 60, 90, whatever days, I think will be the longest of your life. And you should prepare for that.
One resource you would recommend other entrepreneurs use, an online course, a conference. We've already talked about EMP, something that people can buy to educate themselves about the exit process.
Your book's pretty good. I don't want to pitch that on people. I'm not sure as much as buying as it is. I would find people that have done what it is that you want to do in your industry and buy them dinner. Like, take them at that hour and take a notepad and ask them these questions. What did they regret? What would they wish they had learned? To me, all of that peer advice was the most valuable thing that I had during the process.
Trophy you bought yourself to commemorate the exit?
From a health standpoint, actually, I bought a infrared sauna. That was and a what are those cordless vacuums? I wanted one of those for a while.
Robert Glazer sold his business for millions, and he bought a vacuum cleaner. That's the way we're going to market the episode.
That's me. That's our investors. I'm not a trophy guy, but I
bought a vacuum.
Why can't I think? Dyson, those really cool,
Okay, well, at least you bought yourself a higher end one.
Yeah, right. A totally overpriced vacuum. And I bought.
You had me at infrared sauna, by the way.
And I bought an infrared sauna because I needed it at that point too. It was the middle of winter. It was the middle of COVID. So that was the advice I actually got from a lot of folks, and having been, it was, don't buy anything for 6 to 12 months. Like, just wait and see how it plays out, how you feel. A lot of people regretted things that they bought after those events.
Yeah, no, for sure. Sage advice. We're going to do a round 2 next week, but for folks who want to reach out, is there a place they can learn about Acceleration Partners or you personally? Where would you point people to?
Acceleration Partners, you can Google it. It's probably easier than spelling, or it's accelerationpartners.com if you want to learn more about what we do. And then I've got stuff I write and podcasts and some stuff in the experience. That's at 𝙁𝙊𝙐𝙇𝙊𝙀.com.
And we'll put all that in the show notes as well. You also wrote an amazing blog post, which we're going to reference in next week's episode, that gives people some benchmarks to think about and some drivers to think about. And we'll put all that at builttosell.com as well. So check that out. Robert, thank you for doing this.
Great. Thank you, John.
Thanks for listening today. But Robert Glazer's story is not quite over. Next week, in part 2 of our conversation, I'll speak to Robert about his experience evaluating more than 50 deals from the other side of the negotiation table, from the buyer's perspective. I don't think you're going to want to miss a second of this interview. We'll talk to you next week. Hey, so I hope you liked today's episode. If you did and you like this whole building to sell ethos, you might want to give us a follow on the social platforms. There we upload, obviously, every episode of Built to Sell Radio, but also we do blog posts and white papers and ebooks and all kinds of other goodies. Again, all of it on the socials at Built to Sell. Built to Sell Radio is produced by Haley Parkhill. Our audio and video engineer is Dennis Labataglia. If you like what you've just heard, subscribe to get a new episode delivered to your inbox each week. Just go to builttosell.com.
Thanks for listening to Built to Sell Radio with John Warrillow. For complete show notes with links to additional resources, visit builttosell.com/blog. John is the founder of the Value Builder System. To find out how to improve the value of your business by 71%, visit valuebuildersystem.com. John is also the author of Built to Sell, Creating a Business That Can Thrive Without You, and The Automatic Customer, Creating a Subscription Business in Any Industry. Connect with John at facebook.com/built-to-sell or on Twitter at John Warrillow, WARRILLOW. Thanks for listening.